When does it make sense to refinance? That's a question I get a lot. And the answer, like many others, is it depends.
Enough! You better start talking, asshole.
Oh, you should never refinance if you can't reduce your interest rate by at least 1%. Other times I hear, oh, you shouldn't, it has to be at least 2% in order for it to make sense. You should never consider it unless it's 2%. But the math isn't quite that simple, comparing just one interest rate to another. Not to mention, it goes beyond the math. You may have an adjustable interest rate. And even if you refinance and your rate doesn't go down, well, it could be that it's saving you or protecting you from going up. Another reason someone may want to refinance isn't necessarily because of the monthly savings, but they want the long-term savings by reducing their term. A lot of times, you can actually go from a 30-year, or let's just say a 25-year is what you have left, down to a 15. And even though your rate is going up, maybe because of market rates today compared to where they were a few years ago, you could still save tens of thousands of dollars in interest. Or maybe the reason that you are considering refinancing is to get some cash out. Maybe you have some high interest debt that you're trying to pay off, or you have home renovations or repairs that you're trying to make. Interest rates don't matter as much unless it's just an apples to apples comparison, nothing else. But even then, there's other considerations. Let's say that your goal is to save money on a monthly basis. That's it. Just lower your interest rate and save some money. And after running some numbers, you figured out you can save roughly $150 a month. But before you jump into that refinance, you should consider how long you're going to be in the home. Will it be long enough to recoup your closing costs? Closing costs can be anywhere from 2% to 5% of the loan amount on average. Now, with a refinance, typically you just roll those closing costs back into your loan as opposed to coming out of pocket like you did whenever you bought your home. But that doesn't mean that you still shouldn't take them into consideration. And the math on that is actually pretty easy. All you do is take the amount that you pay, like let's just say it was $4,000 in closing costs. You divide your total costs into the amount that you'll be saving each month. As an example, let's say you're going to save that $150 per month, and the closing costs total $4,000. Well, 150 into 4,000 is 26.6 months, just over 2 years. 2 years, 2.5 months. That's how long it will take for you to recover those closing costs. Well, if you're planning on moving in 2 years, you won't have recouped those closing costs. So even though you save $150, which that may be worthwhile for you, depending on your situation, because you need to save that money that bad. But just know that you paid $4,000, you moved or sold the home before there was time to actually recover those closing costs, which makes it less of a benefit to do so. Now, let's take that same example, but instead of saying 2 years that you stayed in your home, let's say that you stayed in your home 5 years. Well, that's a whole different scenario, because basically after that 2 year and 2 month mark, you'll actually be truly saving $150 per month. And over the course of 5 years, and this is with closing costs included, your savings would end up being a net of roughly $5,000. So then it could make sense. But here's another example, and this was with one of my previous clients. She took out a mortgage with me 5 years ago for $300,000. The interest rate at that time was 5.5%, but it should be noted that it was an FHA loan. That means she has mortgage insurance, and she'll have mortgage insurance for the life of the loan. And that mortgage insurance was $200 per month. Well, now she's found herself in a little bit of a bind because she's been putting off some home repairs. They can't be put off any longer, and she's going to need about $4,000 or $5,000 for these pretty much emergency repairs that are needed. And she just found out that she owes for back taxes, and that's going to be another $5,000. So let's just call it $10,000 is what she needs. But interest rates right now are higher than 5.5%. Well, in doing the math again, here's her original loan amount of $300,000 at 5.5%. Her principal and interest payment is $1,703 per month. Add another $200 for mortgage insurance. That brings her current payment to $1,903. Well, she's paid down her mortgage over 5 years to a balance of $277,000. So we'll take that amount and we'll add, let's just say $5,000 as an estimate for closing costs. And then we'll add in that other $10,000 that's going to help her with these emergency repairs and also keep her out of trouble with the IRS. So her new loan amount will be $292,000. And let's just say that she refinanced and the best interest rate that she could get is 7%. 1.5% higher than her current rate. But because there's not going to be any PMI on this loan, because she fortunately has a ton of equity, her new payment, just $1,942 per month. I know there's going to be people who are going to say, yeah, but she's going back out to 30 years instead of 25. There's going to be more interest and all that. But this is going to solve her problem. The big problem that she's having right now, and her payment, her new payment is going to be just $39 per month more than her current payment. So she doesn't have to worry about putting those charges on a credit card for the home repairs, and she can pay off the IRS and get all of these things done. And her mortgage payment, well, it stays really, really close to what it is right now. So again, when you're talking about like when does it make sense to refinance, it's going to depend on your situation. Are you trying to lower your rate and payment? Are you trying to save more money over the long haul by reducing your term? Are you trying to get rid of PMI? Are you trying to take cash out for debt consolidation, home renovations, or something else like paying off the IRS? Everybody's situation is different, but just don't forget you're going to have closing costs, so you need to factor that in to the benefits when you're running the numbers. And don't forget to take into consideration how long you're going to be in the home, because that does make a difference as far as where the benefit lies and if there's a benefit at all. I hope you found this helpful, and if you did, give me a like. If you didn't, give me a dislike. And let me know if you have any questions, whether it's on refinancing, interest rates, debt consolidation, buying a home. I'm happy to help.